Thank you for joining today's webcast. Your moderator for today is Mr. Jose Antonio Bustos. Mr. Bustos, you may begin.
Welcome to today's webcast on country-by-country reporting or CBC reporting. We're glad you could join us. I'm Jano Bustos, and I will be your moderator for today's webcast. First, I want to thank you to those of you who submitted questions when you registered for this webcast. And in fact, we use this to help build the agenda for today's discussion and have attempted to cover as many questions as possible. Now, I'm delighted to introduce our panelists. We are fortunate to have EY professionals with diverse experiences relevant to today's discussion. You will see full bios on your screen, so I'll just say a few words about each of them. First, we have Marlies de Ruyter, recently joined EY in the Netherlands as a tax partner, and she's EY's Global ITS Tax Policy Leader. Marlies has vast experience with international tax policy and specifically with BEPS, as prior to joining EY, Marlies was head of the Tax Treaty, Transfer Pricing, and Financial Transactions divisions of the OECD's Center for Tax Policy and Administration. Under her leadership, the OECD developed 7 of the 15 actions of the BEPS Action Plan, and in particular, the actions on tax treaties and transfer pricing. Also with us is Arlene Fitzpatrick from the Ernst & Young National Tax Office in Washington, D.C. Arlene previously was with the U.S. Department of the Treasury, where she also serves as a delegate to the OECD. Next up is John Dobell, who leads EY's Asia-Pacific Global Compliance and Reporting Practice. John also leads our approach to innovation across tax for Asia-Pacific and also our steering group on client-facing tax technology globally. He has more than 20 years of experience in this space, helping clients create efficient and effective frameworks for delivering timely compliance. Finally, I would like to welcome Patrick Trapp, EY's Tax Performance Advisory Leader for EMEA. Pat has worked for more than 20 years to help clients deal with new reporting requirements and the processes and technologies needed for efficiency and sustainability. Thank you all first for being here with us. Well, so turning to our agenda for today, let me start by a few remarks. Action 13 marks a new chapter on transfer pricing documentation by introducing the so-called 3-tier standardized approach that includes different sets of documentation on transfer pricing. That is to say, the local file, the master file, and the country-by-country report. In today's webcast, we will focus on this country-by-country reporting. And it is fair to say that this reporting, country-by-country reporting under Action 13, is probably the most widely implemented set of recommendations of all of the 15 BEPS action items to date. So, given the level of activity that I'm sure you all know with respect to this country-by-country reporting, I'm sure there is already certain general familiarity with the topic. And in fact, we have also discussed this topic on prior webcasts, and we've talked about the components and basics of this country-by-country reporting. In fact, for those who were not able to watch them, you can view them on demand by going to our website, ey.com/webcast. So on this webcast, we thought it would be useful then to focus on experiences that we have had and what we have seen in practice. Therefore, we have 3 main objectives for today. First, what we want to do is we would like to remind you of what country-by-country reporting entails, as well as bring you some up-to-date on developments around the world, and also look at what this means in terms of filing and notification requirements. Secondly, we would like to look at some of the issues that we have come across in our work on country-by-country reporting and basically our thoughts on how to resolve these issues. And lastly, the third block of today's webcast would be to give you some practical insights in terms of managing your compliance and technology. So let me also tell you that we will be taking questions throughout today's session, and you can send us your comments and questions using the red Q&A icon at the bottom of this interface. We will try to get as many of those questions as we can during the limited time that we will have today. Well, lastly, you can download a copy of the slides of the presentation that we have prepared for you for today's webcast just by clicking on the green folder icon at the bottom of this interface. So let's start then with the agenda. So maybe Marlies, could you give us a quick overview of the requirements of country-by-country reporting, please?
Sure, Hanno. So the Action 13 report introduces the country-by-country report, which requires businesses to report key data points on a country and an entity level. As you already said, it is one of the 3 requirements implemented in Action 13 on transfer pricing documentation. Country-by-country reporting is generally effective from years beginning on or after the 1st January of 2016. So we're already in that year. For example, for those multinational groups, MNEs, who report on a calendar year basis, in general you are already kind of halfway or more than halfway in the base reporting period. Moreover, country-by-country reporting applies to groups with revenues over 715 million euros in the prior year. And that may be translated in local currency by some of the countries. So if you look at the template that was developed, the country-by-country reporting form consists of 3 tables. Table 1 contains numeric data, while Table 2 contains an overview of the constituent entities and their main activities per country. Table 3 is an opportunity for taxpayers to disclose further information to add context to the information provided in Table 1 and Table 2. In general, this report will be filed with the tax authority in the tax jurisdiction of the ultimate parent entity of the group. The residence country tax authority of the ultimate parent entity will then share the report with tax authorities of countries where the group has operations, provided, of course, that a country-by-country exchange agreement is in place. Where this primary reporting mechanism does not work for whatever reason, there are secondary reporting mechanisms in place. The secondary reporting could, for example, be a local filing, so you file with your own tax administration in the country, or what is referred to as surrogate filing, and that's kind of a mechanism that also relies on government-to-government exchange of information, and we will explain more about that in a short while.
Well, thank you very much, Marlene, for that overview. So maybe before we continue, we'd like to get a sense of where you are on your country-by-country journey with this first polling question that will appear in the screen. So the polling question is really what action has your group undertaken to get ready for country-by-country reporting? And there you can click all the boxes that may apply. So maybe while we wait for the results, I do want to mention that various polling questions will appear through this webcast, and you'll need to respond to them in order to qualify for the CPE or C credit. So maybe now, John, let's talk a little bit about the impact of this country-by-country reporting that Marlies just explained. How many groups do we think will be impacted by this country-by-country reporting?
That's a great question, Hanno. And we have attempted on the slide that's on the screen to provide a rough estimate. We pulled a list of groups from one source that have a revenue of over 750 million euros. And we've come up with a list of approximately 6,300 groups worldwide. I do think this is a conservative estimate, though, for a couple of reasons. Firstly, we used euros as the currency to research on, whereas many groups report in dollars or sterling or yen. So there is some inaccuracy in terms of which groups made the cut due to currency fluctuations at the margins. But probably secondly, and more importantly, is that the data that we do have is based on the 2014 or 2015 accounts, depending on what was available in one source. And so that data is also unlikely to reflect private groups and others that aren't required to make their consolidated accounts public. So the revenue figures we used to determine which group should be included in our analysis are also likely to be based on sales turnover and exclude investment income and extraordinary gains. As such, that's different from revenues as defined for country-by-country reporting purposes, which we'll talk about a bit later. Also, we haven't searched for groups identified to see if any national entities only that won't be covered by country-by-country reporting. I should also note that we've shown figures for the US quoted by Bob Stack in October 2015, which is considerably less than the numbers suggested by one source, which showed approximately 2,100 entities. To me, this suggests we're likely to see a lot of movement at the margin year on year as group revenue numbers fluctuate around that threshold.
Okay, John, thank you. Thank you very much. So let me see if I get this clear then. So does this only apply to groups who are headed further in countries that have introduced country-by-country legislation?
No. So the majority of countries that have included, or I guess introduced that country-by-country legislation, require subsidiaries to submit a country-by-country report in the event that there is no country-by-country legislation in the parent jurisdiction. So I guess I expect that there will be a very few of the large multinational enterprises who are unaffected by country-by-country requirements.
Okay, thank you, John. That's very clear. So before we go on, I think that we have the answers to the first polling questions, and there you'll see the results, and which no action yet has been taken is 30%, or then we have the country team identified has already 30% responses as well. We see that many people in the audience have already undertaken dry runs. That we will talk about this in a minute, because 32% answered that they have already started that kind of dry runs. And and tracking and to understand the implication of Action 13 around the world is only 27% of those answers. So okay, that's great. So maybe right after we've heard these results, I understand that some countries are working on data analytics approach with all the information that they will find in the template as part of their transfer pricing risk assessment. Is that true? Is that the case?
Yeah, absolutely, Hanno. We understand that many tax authorities across the globe are recruiting and diverting other resources toward analytics, building their capabilities. And just one noteworthy example we've heard recently, and that is in the Netherlands, where the tax authority has stated that they've recruited 10 analysts and 7 IT professionals to this effort of driving analytics, and specifically focused on the country-by-country reporting data. And as we were talking before the webcast, John, you mentioned that you had seen other examples in jurisdictions. Would you care to elaborate on that?
Yeah, that's right, Pat. And I guess it ties back to increased activity that tax authorities are taking generally around data analytics and electronic auditing. So with countries like Mexico, Russia, Brazil investing heavily in that, as many of us are aware. The initial focus of tax authorities in those countries has been on the sort of indirect taxes, or VAT, but we are seeing them moving to different taxes and taxpayer segments as well. We're also seeing a lot more collaboration amongst the countries, coordinated by the OECD, as a new phase of work. So I guess if you think about it, tax authorities have been building up to this global web of taxpayer data through things like FATCA, the Common Reporting Standards, new disclosure requirements, and then country-by-country reporting in Action Item 13 for transfer pricing. So alongside this increasing information, the tax authorities in many countries are asking taxpayers to submit their information electronically far more regularly, quarterly or monthly, or in some cases even more frequently on a much more regular basis. Essentially, it ties into them trying to move compliance upstream, as it were, moving into real or near real-time reporting. And there's a whole range of reasons for this. I guess fewer people are needed in the process, more value can be extracted from the data, and in some instances for countries, earlier and indeed greater cash collections can arise.
Sure. Yeah, thanks, John. Now, we anticipate that the taxing authorities are going to use the country-by-country data to compute some key ratios and draw some risk-related conclusions around that. And when you consider that they're also going to have much more detail than they've ever had before from both the master files and the local files, these analytics are undoubtedly going to raise some new questions. And, with that in mind, we know that people are focused on how am I going to comply for the upcoming year. But you will hear this message repeatedly through our webcast today. We really feel it's important to take your information, particularly from last year, 2015, or better yet, from the year to date through the quarters this year, and evaluate what that information is really going to say to the taxing authorities when they do the analyses.
Okay, great. So, and John, maybe now it's a good moment to hear your view on this, on how the tax authorities may look at this information in the template.
Yeah, sure. So the OECD views the country-by-country reports as primarily a risk assessment tool. So that'll provide tax authorities with high-level insights into a multinational group's financial and tax profile. Probably the best way to understand how tax authorities may look at this is by taking a couple of excerpts or examples from our Readiness assessment tool, using some illustrative data to show what they might do. So in the example on screen at the moment, this client has operations in 7 countries, labeled as A through G. So what will we expect the tax authorities to look for? I guess for starters, all low or zero headcount countries will be likely to be looked at if paired with high profits and an especially low level of tax paid or financial statements tax charge. You can see on the example here for country D in the graph that they fulfill that category up there in the top left. Additionally, non-resident entities, which will be shown separately, are likely to be of interest, especially those with high profits. I also think a combination of margins, and by that I mean profit over revenues and related party to total revenues, for countries with the same functionality in Table 2, that will be of keen interest to the tax authorities. Again, on the example on screen at the moment, you can see country D would be a great example of that, where those margins highlight that outcome. Of course, there's a lot of other interesting ratios that can be pulled from the data, but I think the ones we've just touched on will be high on the list.
Okay, great. Thank you, John. So maybe, Marlies, before we come to country implementation of country-by-country reporting recommendations of the OECD, you've, as I said, you've been working in the OECD recently. Would you like to comment on whether this assessment of how the data will be used is in line with the conversations in the OECD Working Party?
Yes, Hanno, and I think it's important to add something to what has been said. First of all, I think I can confirm that indeed such analysis will take place. But as already said, it's a risk assessment tool. It's not an adjustment tool. So it can never be the case that the transfer pricing adjustments or BEPS adjustments are only based on the country-by-country data. In fact, if you look at the final report on Action 13, when addressing the appropriate use of the country-by-country report, it states very clearly that jurisdictions should never propose adjustments to the income of any taxpayer on the basis of an income allocation formula based on the country-by-country reporting data. So global formulary apportionment, as it is called, is very explicitly ruled out. It, however, may be the starting point of inquiries or audits, as, of course, the country-by-country report is helpful for high-level risk assessment and may cause kind of questions to be asked either to the taxpayer or maybe additional information to be required or requested from tax authorities. Having said all that, I think it's also important to mention that I was at an EVAC conference yesterday, and there were some discussions about the use, and certain countries indicated that they would find the information useful, for example, in the application of a profit split. So it will definitely have to be seen how things play out. To make sure that, however, countries kind of that have committed to this kind of and to the appropriate use will use the information appropriately, the OECD will be forming an ad hoc group for peer review purposes. And one very specific objective of this group will be to monitor how Action 13 data is used by individual countries. In addition, there will also be a report produced by the Forum on Tax Administrations. And for those that don't know the Forum on Tax Administrations, all kind of tax administration commissioners are in this group. And they will be making a draft report on the effective use of the country-by-country reports. So there will be clear attention for the way the country-by-country reporting is implemented by countries.
Well, thank you, Marlies, for this very much updated information here. So, Arlene, now let's move to where we are in terms of implementation of country-by-country reporting recommendations. What can you tell us about where we are on that respect?
Sure. Thank you, Hanno. The first thing I think I would like to stress in that respect is that Action 13, country-by-country reporting, is a minimum standard, with all 85 BEPS associates committing to implement country-by-country rules in a consistent fashion. The BEPS associate consists of both the original OECD G20 BEPS countries and a large number of countries that have committed themselves to the minimum standard at a later stage. I think this shows the impact of the BEPS project goes beyond the original participants to the project. And as you might expect, many countries have been very busy implementing the country-by-country requirements under Action 13. For example, in some countries, it may have been necessary to introduce a legislative or a regulatory change to effect changes with respect to country-by-country reporting. And in others, like the United States, proposed and final regulations had to be issued in order to implement the new rules. In addition, it's also worth noting that it's necessary to put a process in place to actually collect the data. And so, for example, countries will have to issue some sort of form and instructions. I know that's the case in the US, in order to collect the data going forward. And as you can see on the global map, 18 countries have already finalized their legislation or regulatory process, with another 15 having legislation in draft form. And then by signing up to the Multilateral Instrument on Country-by-Country Exchange, another 14 countries have signaled that they will follow suit. And we should also not forget the revisions to the Administrative Cooperation Directive that were agreed to earlier this year, which will extend country-by-country to every EU member state. So countries have, I would say, by and large, followed the country-by-country model legislation that was set out by the OECD in the final report, with some of the main differences relating to the start date, differences on secondary reporting requirements, notification requirements that we'll talk about later, as well as some of the terminology. The majority of countries who have implemented C/C have followed the OECD recommendations to commence reporting for fiscal years commencing on or after January 1, 2016. Action 13 acknowledges that some jurisdictions may have needed time to follow their particular domestic legislative process in order to make the necessary adjustments in their law to effect these changes. And in that regard, you see Japan and India having effective dates for accounting periods commencing on or after April 1, 2016. And with respect to the US, the effective date is for tax years beginning on or after June 30, 2016. Also noteworthy is Russia and Uruguay, January 1, 2017, and Switzerland, January 1, 2018. Some of these countries with a later start date have opted to introduce what we are referring to as voluntary filing for 2016. Russia, Japan, Switzerland, and the US are allowing companies to file on a voluntary basis for the accounting periods commencing on or after January 1, 2016. With the parent jurisdiction that they are covering the filing gap, so they're covering the filing gap between what would be required in many subsidiary jurisdictions and the head office country rules. In the case of voluntary filing, provided certain requirements are met, including a notification requirement, the reports would be filed and exchanged under the exchange mechanisms established by the ultimate parent entity's tax jurisdiction of residence.
Okay, thank you very much, Arlene. So maybe now is a good time to discuss then these different reporting mechanisms, including this secondary reporting that we have been just mentioning. But maybe before we do that, let's bring up the next polling question here, which really relates to the identification of the reporting entity. So there you'll see what we're asking is that has your group identified the reporting entities? And for this one, you should pick the answer that best applies in your case. Maybe while we wait for the results of the polling question, Arlene, perhaps you could start the discussions with these reporting mechanisms, please.
Yes, sure, Hanno. So reporting would generally be required in the ultimate parent entity, or UPE, country of residence. The expectation is then that the UPE's tax authority will provide the report to all of the tax authorities where the multinational enterprise group has operations through the automatic exchange of information agreements, and that would be pursuant to a government-to-government agreement based on the new multilateral instrument, or a bilateral tax treaty, or a tax information exchange agreement, or a TIA. And a multilateral competent authority agreement to facilitate the exchange of the reports has been issued, and 44 countries have signed up to that. As you can see from the slide, most countries appear to be using the multilateral approach. Some countries, such as Turkey and Pakistan, have not yet signed. And then with respect to the U.S., it's expected that the U.S. competent authority will enter into competent authority arrangements for the automatic exchange of country-by-country reports under the authority of an information agreement to which the United States is a party, so for example a tax treaty or the tax information exchange agreement. And so over the coming months it will be important to track the progress made by the U.S. with respect to the competent authority agreements in order to confirm that the necessary legal agreements are in place to facilitate the actual exchange of information.
Okay, yes, Arlene, that's right. But I don't know, maybe it's worth also saying here, no, that under the terms of the directive, EU directive that implemented country-by-country reporting, in fact, if an EU tax authority receives a country-by-country report from a reporting entity, that report will automatically be exchanged with all other EU member states tax authorities where the group is operations. So there we have another exchange of information mechanisms that will apply in the future for this country-by-country reporting. So maybe let's turn to the topic that we said on secondary reporting. And in fact, what happens if a country-by-country report is not provided by the tax authority of the parent jurisdiction by using the primary reporting process that you just referred to? So maybe Marlies can get us started on this. How these secondary reporting mechanisms should apply?
Yes, thanks, Hanno. Yes, as you said, it will not always be possible for the report to follow the process explained by Arlene, so to go to the ultimate parent entity and then be exchanged. For example, if the parent company is located in a jurisdiction that has not introduced country-by-country reporting, doesn't have the legislation, that cannot be done. Or if it does not have an agreement to facilitate the exchange of the country-by-country report with the subsidiary jurisdiction, of course such exchanges can also not be done. A final reason for kind of not being able to use the primary mechanism is if there is a systemic failure with respect to the practical kind of exchange of the information, the reporting itself. In all these situations, the OECD has provided a secondary reporting mechanism. And actually, there are two secondary reporting mechanisms in place, which will make sure that even though these issues with the ultimate parent entity exist, the report will nevertheless go to the subsidiary countries. So the secondary mechanism may take the form of either, so there are two possible ways: a local filing requirement whereby the tax authority in the subsidiary jurisdiction mandates that the local subsidiary should file the report for the entire group. So you have the country-by-country report for the whole group, and it's given to the local tax authorities by the local entity. A second possibility is to use another form of exchange between governments and governments, and that's surrogate filing. In that situation, the parent company appoints a surrogate entity in another tax jurisdiction to file the country-by-country report on behalf of the ultimate parent entity MNE group in the surrogate entity's tax authority's country. So in that situation, the surrogate parent has filed in its country, and then the surrogate entity's tax authorities would exchange that information based on the automatic exchange mechanisms that they have in place. So it's a bit the same as ultimate parent filing, only in this situation, a replacement for the ultimate parent is selected.
Okay, thank you very much, Marlies. And before we continue, I think that we have the results of the previous polling question that, if you remember, was, has your group identified the reporting entities? And there we have that, based on the responses, 31% of the audience marked no, not being considered yes. To me, that's kind of surprising. Then we have that yes, voluntary filing in Paris jurisdictions, we have only 17% that mark that answer. Then we also have that yes, ultimate parent will file. We have for that 46%, so it looks like many of the groups that are listening here, the webcast, are understand already that the ultimate parent will file, and this will be exchanged in the manner that Marlies just explained. And then we only have 4% saying that no country-by-country legislation is in the parent jurisdiction, so surrogate will be appointed, which also kind of surprised to me that this surrogate mechanism is not under consideration so much for the people that are here with us in the webcast today. So, okay, maybe with those results we can now move to Arlene. What countries are doing in practice in terms of reporting mechanisms? What do we see?
Sure, Hanno. In practice, all the countries that have implemented the country-by-country reporting have followed the OECD guidance in terms of the primary reporting. So what we mean by that is full C/C reports will be expected to be received from the parent entity's tax jurisdiction. So while the majority follow the OECD guidance in relation to secondary reporting, that is for there to be local or surrogate filing in the event that the C/C report will not be provided by the ultimate parent tax authority that Marlies just discussed, we do see some different approaches being adopted in certain countries. And there isn't time, unfortunately, to go into all of the different country implementation, but let me just pick a few examples. So with respect to the United States, for example, there's no secondary reporting mechanism. When you look to Austria and certain other countries in the EU, they've adopted not to implement secondary reporting for the first year, so that would be with respect to the first year being 2016 filing. So in that case, if a report is not obtained from the parent company's tax jurisdiction, then there would not be additional local filing obligations for 2016, so sort of a transition period adoption there. And when you look at China doesn't permit a group to appoint a surrogate, and there's no automatic expectation of local filing, but we understand that Chinese tax authorities may request a local entity to provide the report as part of an investigation or audit. And so most countries anticipate that the local country would be, the local filing would entail the filing of the full C/C report for the group. But with respect to the UK, in the event that a C/C report is not provided by the ultimate parent entity or the surrogate's tax authority, then the UK would expect the top UK company in the group to provide a C/C report that would cover the top UK topco and its holdings. But obviously, if the group wanted to use the UK entity as a surrogate, then they would be expected to file a full C/C report. And then finally, as mentioned earlier, we should also remember the EU Administrative Cooperation Directive that introduces the concept of an EU surrogate that would be able to file on behalf of the EU subsidiaries.
Okay, great. Thank you, Arlene. But maybe I can just interject here because and make a point, because really countries, what I see is that are approaching to this secondary reporting in a very different manner, and what we're seeing is that this is still really taking shape, and we'll hear more and more as guidance is being issued. So, and I can give you the example here of Spain. Let's say that in the case of Spain, for instance, the Spanish legislation that came out more than a year ago appeared to rule out this possibility that we were saying of a group appointing a surrogate. But then, after a while, then a draft guidance came out, and more recently, and it looks clear that they will actually accept the report from a surrogate jurisdiction. And I think that this is a great example of that illustrates how the situation is on this country-to-country reporting regulations, and it's still very fluid, and that means that it's very important to keep abreast of these changes. But maybe I would like to come back to something that was mentioned before on systemic failure, because we mentioned that this systemic failure is another element that could trigger local filing. But maybe, Marlies, could you expand on that and tell us how do you see this impacting country-by-country reporting in the future? Is this going to be something that will apply in the future?
Sure, Hannah. So when we talked about local filing, we mentioned that an entity may need to do local file if a country-by-country report in the parent entity is not required, or if there is no agreement in place to exchange the mechanism. The third possibility that can trigger secondary reporting is that despite there being an exchange agreement, the exchange itself doesn't take place. There is a failure to exchange. And if this kind of happens systematically, this is known as a systemic failure. Since this item depends on the exchange not effectively happening, it will not come up immediately, because the first exchanges will only take place in June 2018. So we may see the systemic failure in practice only from the 2018 reporting fiscal years onwards.
Okay. Thank you, Marlies. So maybe back to you again, Arlene. So if I understand correctly, if I get it right, it seems to me that there is a chance that the M&A groups would have to report in many different countries under these local filing requirements that we have been explaining, and that is something that, to me, and that's what I have heard from the clients that we have, is that they will likely try to avoid. So is there anything, Arlene, here that we could advise our audience in that respect?
Yeah, let me try to sum up, Hanno. So MNCs headquartered in country-by-country jurisdictions, they would need to track the tax jurisdictions in which they have operations and that have implemented the C/C rules, and then look to see if there's an agreement in place between the ultimate parent entity's tax jurisdiction of residence and those other jurisdictions that would permit the automatic exchange, such as I mentioned earlier, a bilateral or a multilateral tax treaty. And if such a treaty is not in place, then the company would need to consider the secondary reporting rules in the affected jurisdictions, and I guess they could identify a surrogate entity, or they would also need to consider whether they have a local filing obligation. And then when you think about MNEs headquartered in jurisdictions with the delayed effective date, so some date after January 1, 2016, they would need to consider whether they want to make a voluntary filing for that year, where that is an option, or undertake some version of the secondary reporting, either the surrogate or the local filing. And then, when you think about MNEs headquartered in a non-C/C jurisdiction, where they have operations in countries that have implemented the country-by-country legislation, they're going to have to consider the secondary reporting mechanisms, and I think that was flagged up in the last poll. And they will need to investigate the requirements in those jurisdictions where their subsidiaries are, and appointing a surrogate where possible. And I think when you think about all of this together, it's important that the M&E groups take into account a number of considerations towards making sure that they have efficient and effective compliance for country-by-country reporting. Otherwise, you're right, you could end up having multiple filings in different jurisdictions, which is going to entail a lot more work and compliance cost.
Oh, yeah. Thank you, Arlene. So that maybe brings me to the point on the importance, at this stage of understanding what must be done and probably also when this has to be done. So maybe, Marlies, could you give us an overview on this?
Yes, so I think, as is clear from all the kind of discussions, this process is very dependent on everyone knowing what's going to happen, who will get the report, and what needs to be exchanged when. So understanding which entities in the group will need to report next year in respect of the fiscal year 2016 is of immediate importance, as this will determine the notifications that you will need to make and to the authorities, and also to which authorities you will need to notify. So notifications are crucial for informing all the relevant authorities about how the MNE group will be filing the country-by-country report, who to expect the report from, and thus whether local filing is activated. To get this right, coordination within the MNE group will be key, as the notifications come from the local constituent entities resident in the respective countries rather than the head office. So everyone that is a constituent entity needs to give notifications. The OECD model legislation requires notification before the end of the reporting fiscal year, which for many MNEs will be before the end of 2016. This means that it is critical to know very soon which entities in the group will be required to report for the fiscal year 2016.
Okay, so we are already talking about notifications, so maybe that's a good moment to have a quick question on that. So in the polling question, you'll see that what we're asking here is that have you determined where and when you need to file notifications? Please choose the one that best applies to you. And maybe Marlies, again, while we wait for the responses, and how about the who? Who do notifications apply to?
Yes, thank you, Hannah. It's worth flagging that notifications will be required, but as yet there is little formal guidance from countries in terms of content and format required. Notifications requirements generally apply to any constituent entity of a group. The requirements may vary depending on whether the notifying entity is the ultimate parent entity, the surrogate parent entity, or not even a reporting entity but just a subsidiary in the group. The notification requirements may also vary in the case of more than one constituent entity resident in the same jurisdiction or in the same region. The first step or to do for MNE groups subject to country-by-country reporting requirements is therefore to notify the pertinent tax authorities. Additionally, notification requirements generally seek to gather information on the reporting entity and potentially include the name, address, tax identification number, jurisdiction of residence, and nature of the reporting entity. For example, the ultimate parent entity or the surrogate parent entity, or the constituent entity locally filing the country-by-country reports for all entities in the country. There are secondary or accessory notifications to inform the pertinent tax authority of concrete, particular situations such as ceasing of the obligation to prepare country-by-country reporting, or, for example, appointment of an entity to notify on behalf of the other constituent entities resident in the same jurisdiction, among others.
Okay, no, interesting. So this looks to me like a lot to do here. So maybe and where and when would these entities need to notify then?
So actually, it's not that difficult because kind of basically what you will get is that in domestic scenarios, the notifying entities will inform the tax authorities where they are resident. So all constituent entities of the group will go to their own tax administration. Nonetheless, there could be extraterritorial notifications. For example, in the UK, if a UK ultimate parent company, so if you would like to appoint a surrogate parent entity in the UK, the ultimate entity of the group would need to notify HMRC. Regarding the second part of your question, notification requirements generally need to be satisfied by the last day of the reporting fiscal year of a given MNE group. So the fiscal year where the numbers are and operational results are reflected in the country-by-country report. Nevertheless, countries may opt to use other due dates. So, for instance, notifications may be required before the due date for filing the income tax return, or, for example, by the last day of the fiscal year of the notifying entity, or before the year end of the calendar year. The number of times an entity is required to notify may vary from country by country also. Notification requirements could be applicable only once, during the first reporting year, for example, every year, or when there are relevant changes, for example, change of the reporting entity, ceasing of the obligation to prepare country by country reporting, etc.
Okay, Thank you. I think that we have the answers to the previous polling question. If you remember, that was, have you determined where and when you need to file notifications? And here what we have is that the answer for no, not being considered yet, is 50% of the audience. Then yes, working on it is 45%, and then C, yes, notification finalized and just waiting for news on the required format is only 5%. So I'm kind of surprised that knowing that, as you said, Marlies, that these notification requirements will come up, I mean, immediately, let's say in some cases before the end of 2016, 50% of our audience has not yet considered this. So that I think that's interesting. So maybe, Marlies, to continue, what are the consequences that could arise from not complying with this notification requirement?
Yes, so if you look at the notification requirements, they generally serve to deactivate one or multiple secondary filing mechanisms. But they could, for example, also serve to activate surrogate parent filing. So in other words, there will be an automatic presumption that the local entity will file locally, together with penalties for missed deadlines. In many cases, for example in Japan and in Spain, notifications are required to appoint a local entity to file on behalf of its sister local entities. So not complying with the notification requirements could lead to either monetary or non-monetary penalties, or for example also both.
Okay, thank you, Marlies. So, anything else to add on notification before we move to our next topic?
Well, as also came from the polling questions, what you see is that kind of both taxpayers and countries are still trying to find their way on this. So we anticipate that this topic will continue to evolve, but one can see issues with notifications over the course of the next year coming up. So whilst the exchange mechanism gets bedded down, questions will keep occurring, and we are also trying to reach out to the OECD to get more clarity on this.
Yes, it's clear then, to me, that there are many different approaches. So maybe, John, can you tell us about your experience on how companies are navigating this I would say, turbulent water?
Sure, Hanno. So I guess as Marlies already mentioned, as a firm we've been tracking the country-by-country implementations. We've developed a tool to identify which entities in the group will have to file and the timing and the nature of those. That's obviously being updated as we get more information, and people can reference that at ey.com/BEPS. I think the real issue, though, is that there's considerable uncertainty here. The constituent entities, as we heard, need to notify by the end of the reporting fiscal year who the reporting entity is. Yet the information that relates to exchange agreements might not be available by that stage. The draft legislation, in fact, requires those exchange agreements to be in place by the date of the filing. So, in other words, 12 months after notifying. So what that means is for these first wave of notifications, they're actually going to have to be based on assumptions. So, for example, if you're a US multinational and you've decided to opt for voluntary filing, it's unlikely that it's going to be obvious come this December whether the competent authority agreements to facilitate the exchange will be in place or not with all the other jurisdictions around the world by the end of the following year.
Yeah, that's right. And maybe I would like to jump here to say that, in fact, EY has explained these problems that you just raised here relating to notifications to the OECD, especially in this startup phase, and to suggest that this tax authority should adopt a flexible, or if we call it a soft landing, let's say, approach to begin with. So maybe let's after this, let's move to the interpretation issues. Marlies, how countries are interpreting their requirements? Because what's seen here is that some countries, or I would say the vast majority of them, tend to follow the OECD definitions in their recommendations, but then we also see many differences as well in the legislation and guidance that is coming out. So can you tell us about this difference and that we have already seen?
Yes, of course, Hanno. So to give an example, the Dutch legislation additionally requires addresses for each local constituent entity, And the US legislation requires tax identification numbers for such entities. And of course, this may be because these governments have recognized that this is necessary for the XML upload of the electronic filing format without knowing who to send it to. It's a bit difficult. So Ireland and Japan also refer to this in their additional guidance. Another example, Portugal requests employee numbers that are year-end, while, for example, Spain would ask for average number of employees per year. Another example is that Spain defines the constituent entity and the group by reference to the entities controlled by the ultimate parent entity, whereas most countries follow the OECD definitions and suggest that only entities that are fully consolidated should be included in the country-by-country report.
Okay, so let me see if I get the logic of this. So the reporting entity will produce the report using local guidance. I think that's clear. So coming back to your example of those two countries, so if a Spanish group will use the Spanish, let's say, definition of the group as they have to, and use also average head count for the year. Let's say that now this Spanish group has operations in the Netherlands. I was saying that the Dutch authorities could then demand some additional information on their country-by-country report under the Dutch rules, so that they will include constituent entities that meet the definition, or maybe ask to provide tax addresses?
No, I don't think so, and I think that's the best approach. So the Dutch will receive the report from the Spanish tax authorities by automatic information exchange based on the Spanish rules.
Okay. Thank you, Marlies. So maybe let's move on with something that I think is going to be very interesting for the audience, because they raised a lot of questions before the webcast, and this is about the interpreting country-by-country terminology and in the context of a particular M&A group. So maybe Marlies, again, can you start the discussion here?
Yes, sure, Hanno. So if you look at Action 13, it does definitely not provide granular guidance on what data to include and how to actually interpret the requirements. And this lack of guidance may actually have been intentional in order to give some flexibility to those preparing the report, because everyone has different practices. If we turn what countries have done so far, some tax authorities, such as the Irish and the Japanese tax authorities, have addressed this by producing supplementary guidance, and this helps reporting entities in their jurisdictions. The OECD also released additional guidance in July on points that are causing confusion and that were related to them. In addition to dealing with voluntary filing mechanism, which we have already discussed, the OECD guidance clarified how to treat investment funds and stateless partnerships, as well as dealing with the effect of currency fluctuations in relation to determining whether the threshold of 750 million euro has been met. So this guidance was published in July, and the OECD have said that they will continue to release additional guidance over time.
Okay, thank you, Marlies. So maybe I would like to add to that last point on the threshold, because here the OECD reiterates in the guidelines that during the BEPS project a threshold of this threshold that you mentioned of 750 million euros was agreed, or a near equivalent amount in domestic currency as of January 2015. So provided then that the jurisdiction of the ultimate parent entity has implemented a reporting threshold that is a near equivalent of that threshold in euros, then the group that complies with this local threshold should not be exposed to local filing in any other jurisdiction that is using a threshold that might be denominated in a different currency. So maybe it's a good moment now to address some of the questions that I said that we have received from the audience. So let us look at some of them that relate to table 1 of the template first. So we've received quite a lot of them with respect to the interpretation of revenue. And maybe here, Pat, can you tell us what should be included in revenue?
Sure, Hanno. I'd love to talk about revenue, but let me give a little bit of a broad approach to dealing with these interpretation issues. And kind of working through all of the guidance that's out there, we think really there's kind of a hierarchy to go through your thinking. And the first starting point on these interpretation issues would be to take a look at what's in the financial and regulatory accounts of the entity, both at the headquarters and at the jurisdiction that that the issue may be in. After that, taking a look at the country-by-country reporting guidance that's relevant to that local country. And then thirdly, to always consider your preliminary answers in light of consistency, and that consistency both across the globe and with each of the elements that are reported. And just an example, something that might be excluded from revenue but is included in profit before tax would, of course, affect your profit margin. So keep that in mind as we work through some of these things. And revenue has been one of the items that we've really had to talk a lot about. Now, what do we know for sure? We know from the guidance that included in revenue is the sales of inventory and property, services, royalty, interest, and premiums. And we also know that there's at least one absolutely excluded area, and that would be the receipt of a payment from a constituent entity that is treated as a dividend in the payer's jurisdiction. So that's definitely not in top-line revenue. But there are other areas that we have got lots of questions on, things like miscellaneous capital gains, extraordinary income, currency gains or losses, investment gains or losses. Are these in revenue or not? And so hence the whole discussion about interpretation issues. When you look at what's been published by the OECD guidance, you'll see that they really don't have any examples on items that are capital in nature, although they have this catch-all phrase of any other amount. So you can assume that that's can be broadly interpreted. But on the other hand, when you look at accounting standards and you drill into the definition of revenue, it's generally referred to as income arising in the ordinary course of business. And so you could make a case that extraordinary items really aren't in the accounting definitions of revenue. So when you look at this guidance, then you go to the next level and then say, well, what's been out there in the guidance from the various countries? And a couple of things are noteworthy. As mentioned earlier, Japan would definitely include many of these items in their definition of revenue, specifically citing foreign exchange gains. And the Irish guidance has also suggested that a broad interpretation of revenue is appropriate. So there are some interesting questions out there on these items of included or excluded gains, and we just would point out to be thoughtful about your interpretation here, and particularly considering consistency. And as we'll talk about a little bit later on, we really think you should give some good thinking to whether these sorts of approaches need to be listed in your Table 3 to provide clarity and avoid confusion.
Okay, thank you. Thank you very much. So maybe we can move to the next item that raised questions from our audience here, and that was about the item on profit or loss before tax. And particularly, the audience was interested in whether dividends received from constituent entities should be included or not in the template. So maybe John, can you please take this one?
Yeah, sure, Hanno. I guess generally, and it obviously depends on the accounting treatment under the local GAAP of whether investments in subsidiaries are treated, but dividends can be included in profit under accounting guidance. Dividends received are generally above the line item in that local financial statement and included in earnings before tax from an accounting point of view. So I guess you have to take that general principle and then look at where it goes. So while the OECD guidance is explicit that the profit or loss number before income tax should include extraordinary items, it's silent on the question of whether intercompany dividends should be included or excluded from profit and loss before income tax. That's actually in contrast to the guidance also from the OECD on how revenue is defined, where the OECD guidance is that intercompany dividends received should be excluded, as Pat just mentioned. So the issue is that if you include intercompany dividends in the profit line, but you exclude them from the revenue line, you could end up with some of those distortions in the profit margin that we looked at on the graphs before. So it's interesting to see Japan, for example, has given some guidance that dividends received are to be included in profit, but conversely, we've had informal discussions with other tax authorities that say it should be left out. So really, I think it comes down to the fact that multinationals really need to keep abreast of what the tax authority guidance is doing here. And we should also keep in mind, as Pat mentioned, we've got Table 3 to provide additional information where relevant around the report.
Okay, got it. So, thank you. Maybe if we move to the next question or item that raised question from the audience is the withholding tax in the current year, tax accrual, and in particular, what is withholding tax reported in the income tax accrued current year of the recipient? So maybe, John, can you please again take this one?
Yeah, sure. I guess, so while the specific instruction on the cash tax paid in the year does include withholding taxes paid, the instructions on income tax accrued is actually silent on it. But it seems reasonable to include the withholding taxes in the tax charge, and as we said before, take advantage of that Table 3 to explain it.
Yeah. Well, and in this case, I mean, this is interesting because in the case of Spain as well, the draft order, the draft regulation that I just mentioned before, provides explicitly that the income tax accrued should include these withholding taxes, and also the Portuguese country reporting rules say the same thing. So maybe let's move to the next item that raised question. That one is on stated capital. So John, what is meant by stated capital? Does this stated capital include additional paid-in capital, share premiums, preferred stock, accumulated other comprehensive income, and the like?
Yeah, great question. I mean, the OECD discussed the purpose of that stated capital during one of their business consultations. And in fact, if you go back, first up, they had one column for both stated capital and accumulated earnings. And they explained that they would actually like to see if there were any countries with entities that had a lot of profit that was accumulated, and so that was the rationale for now breaking it out into the two categories we see in the final version. So looking at the actual stated capital piece, one approach would be to take it as share capital only. In other words, ordinary shares and preferred share capital, if that's treated as equity, obviously, in the country. However, there are good arguments to include share premium on the basis that, otherwise the tax authority's view of that capital would be understated. I guess if you adopt that basis, equity accounts like common stock, exchangeable shares, treasury stock, preference shares, and other additional paid-in capital could all be included in this category and could be reported. I think looking to the definition of capital under the type of GAAP or accounting principles used for a particular country could also be a valid indicator for presentation. And I guess regardless of the chosen interpretation, a couple of points to note. Firstly, consistency year to year will be key. And secondly, again, whether Table 3 should be used to spread it out. I think one point to call out, though, is that some clients will show branches or permanent establishments as standalone entities in their accounting systems. So we should be aware that there might need to be manual adjustments to, I guess, rebuild that stated capital number and make sure that it's covered in the right constituent entity. That's explicitly prescribed for in the OECD guidance. Okay,
thank you, John. Maybe another question that raised by the audience was in relation to tangible assets, and here what they are asking is what should we include in tangible assets? And in fact, the specific question is should we include receivables in these assets? So can you, John, take this one?
Sure. The final report for Action Item 13 is clear that we should definitely include tangible assets like plant, property, machinery, and so on, and exclude cash and cash equivalents and financial assets. So what we need to do is actually examine the accounting standards for the definition of financial assets. Receivables are treated as financial assets under IAS 32, for instance. And so I guess our view at the moment is receivables should not be included in that tangible assets piece. One other one that's worth highlighting is software. because I guess the treatment of software also depends on the group treatment. So sometimes it's a tangible asset, sometimes it's intangible. So overall, I think there's a bit of focus that needs to happen around this.
Okay. So maybe we can move now to the next item that raised some questions. That's the number of employees item. There has been some questions around this term, and in fact, if we should consider independent contractors for that purposes. So maybe Arlene, this one you can take this one for us.
Yeah, sure, Hanno. I mean, the Action 13 final report does permit independent contractors participating in the ordinary activities of the business to be included when looking at the number of employees. And generally, I would say that we find that most of the MNEs groups are trying to make every effort to identify their independent contractors and make sure that they are reported. I mean, it's not uncommon for companies to use independent contractors to fill many positions, and inclusion of independent contractors would impact the earning before tax per head ratios. So careful review of your independent contractor arrangements is very worthwhile exercise to make sure all of those employees are counted. Sometimes this will involve going between tax, finance, and human resources to work together to get all of this data pulled together. I mean, another area that comes up is when you've got people moving around a lot and trying to figure out where those folks should be reported. So some of the practical things you need to think about are, where are those people providing the value? How is the location being reflected in the human resource records? Are you being consistent with permanent establishment disclosures and things of that nature? And I would point out in the U.S. regulations that they have a rule in there that provide that employees of the constituent entities are reflected in the tax jurisdiction of the constituent entity.
Okay, thank you, Arlene. So maybe time for another polling question here. So this one is: which areas of country-to-country reporting are causing the most uncertainty for you? Then you can select all that apply in that case. So maybe next issue that we have coming from our audience is one that is pertinent really to both Table 1 and 2, and that's on the definition of constituent entity, and in particular, what entities should be included in the template. And here, what I think that we all know is that the Action 13 guidance is clear that you should include all entities that are fully consolidated. But maybe, Pat, I should like to pick a few types of entities to get your thoughts regarding treatment. Maybe we can start with the investment funds, because here what we see is that investment funds have majority stakes in entities that are holding for investment purposes. So how this should be reported or treated?
Well, I know there were a lot of questions on this, and so the OECD issued some supplemental guidance this past July, and really the guidance just follows the general principle that you indicated, and it basically is the consolidation test. So if a company consolidates the investee company, then it would be included as a constituent entity. But if, on the other hand, the proper accounting for that investee company is, the fair market value accounting approach, where it's carried on the owner of the entity at fair value, then it would not be a constituent entity for country-by-country reporting. But one of the things that we just want to make everyone aware of is that investee company needs to think about whether it is a multinational entity that is subject to reporting, country-by-country reporting as well. So both at the owner level and at the investee operation as well.
Okay, thank you. That at least we have some guidance on investment funds here from the OECD. So maybe let's look at some other particular types of entities that have raised some questions. And maybe we've already talked a little bit about some of them, but maybe let's start with partnerships. So how should we disclose partnerships in the template, Pat?
Well, I just want to focus on one of the new pieces of guidance that was also in this July release, and it had to do with the so-called stateless partnerships. Those are partnerships that the activity hasn't risen to the level that it's created a permanent establishment in any jurisdiction. So what this most recent guidance said is basically a partnership like this, and as you see it on the chart, where it's owned by a member within the group, actually gets reported twice. Once on the stateless entity line, and each partner's share of that activity included in the jurisdiction where the partner operates. So that's a new piece of guidance. We'll require you to look through it, and so pay attention to this new guidance if you've got these stateless partnerships and other stateless entities. You want to pay attention to what your country is saying about those, if anything.
Okay, thank you. Maybe we've talked about permanent establishment a little bit before in the webcast, but maybe let's take it from the point of view how to report it as a constituted entity. So what we've seen sometimes, and someone raised this question, is that some cases jurisdictions do not have a permanent establishment concept in their domestic legislation, and what they have is some kind of concept of taxable presence. So should we assume that this is the same thing in terms of reporting? Maybe Arlene, here you can take this one.
Yeah, Hanno, I mean, Annex 3, I think, of the final report specifically dealt with branches and PEs, and the guidance tells us that the PE data should be reported by reference to the tax jurisdiction in which it is situated and not by reference to the tax jurisdiction of the business unit of which the PE is a part. And it seems reasonable to conclude that the intention there was to include a concept akin to branches and PEs. So if you have a situation where your country doesn't have a concept of PE in its domestic legislation, but a tax is based on presence in that jurisdiction, I think it would be reasonable to consider that as akin to a PE for C/C purposes. And also important to look to the local guidance, if to the extent anything has been issued by the country that you're trying to evaluate. In the U.S., the regulations, they do have a definition of PE in those regulations.
Okay, thank you, Arlene. So maybe in the interest of time, I think that we should move on from this very exciting piece of interpreting the guidelines. But maybe, Pat, you're working with clients to implement country-by-country reporting into their systems. What do you think the groups should be doing in relation to these interpretative issues that we have been discussing now?
Well, the key message, I think, is just pay attention, do some analysis, and particularly consider consistency across the globe and from year to year. Where we've spent time with clients on this, we know that they've involved people from accounting, from tax, from HR, and from the IT department in working through the interpretive issues and making sure that they get a position that they feel is defensible and sustainable, again, for consistency purposes. And a lot of times the outcome of that analysis is a set of instructions or a procedure manual and some templates that the people who do the data gathering and analysis, not only for 2016, but going forward, can use on a recurring basis. And so really the watchword here is be thoughtful and think about consistency.
Okay, thank you. So I think that with that, we can move to the next topic of our agenda on that dealing with compliance and technology. So maybe, how can we better be ready for this country-by-country reporting? But maybe let's start with a polling question here to see whether the audience has thought about the tools that they are planning to use. So please, you see there, what we're asking here is what tools are you planning to use to prepare this country-by-country report? And you'll see there that there are many options here. So maybe, Pat, you've helped a number of clients undertake dry runs in getting ready for country-by-country reporting, and that we talked about. What have been some common themes that have arisen, and how is this informing the approach for next year?
Right. Well, first thing I'd like to say is let's just recap quickly one of the key decisions that you will have already made or you're going to make, and that is what is the primary source of data that I'm going to use to satisfy this country-by-country requirement. And the guidance really is quite flexible here. It allows sources such as the consolidating work papers for the consolidated financial accounts, local financial statements, if appropriate, regulatory statements and accounts and or management statements and accounts. And in general, we've seen clients choose between one or two main approaches. And the first approach that we see really most commonly is the top-down approach, and that is taking the consolidating financial information, enriching it with local data such as headcounts and maybe a more accurate split than can be seen in the consolidation accounts between the total tax provision and the current tax provision. And then the second approach is more of a bottoms-up approach where we have information requests going out to the local units, coming back to headquarters for it being assembled and to prepare the reporting. You see this local request both to supplement the data sometimes, but frequently when there's been a lot of time invested on using the statutory accounts as a good basis to prove transfer pricing, it's logical to think about whether a bottoms-up approach may serve your overriding purpose of clarity and consistency. Now, when we've seen companies take the top-down approach, I just want to mention to you some of the frequent issues that you can expect to run into, just so that it's an encouragement to get started and be thorough when you get into your dry run. So one is that we see that not all of the data that we need is available in the consolidating financial statements, and the typical one is embedded branches and permanent establishments that are embedded in the accounts, maybe embedded in the ledgers, and get reported up in a way that's not visible. You got to go and find those pieces of data and break them out. We've also had a lot of discussions with what about the top side entries that are made in the consolidation system over and above the accounts. And then, as I mentioned previously, the granularity question, do we have visibility to the kind of data points that we need? And the one we frequently deal with is this one on tax provision, where the total tax expense comes through, but maybe not the elements necessary to break it out. I would say also that we have run into a number of issues that basically deal with the matching up of legal entities. Do we have all of the legal entities in the financial systems in a way that we can see them? So expect that to be an issue. In that area, we frequently find dormant entities not fully visible in the financial statements. And of course, almost always you have to do some supplemental work to get the head count right. And John, I know that you've done a lot of this work as well. So what are some of the things that you've seen that I may have missed?
Yeah, look, I think there's two key points that I'd add to that, Pat. The first is that, this is all about making sure there's a clear audit trail that shows where you've made adjustments from whatever that reporting information is to what's ultimately being filed, so that you've got consistency from year to year and you can trace that back. The second is that this actually ends up being about collaboration in the organisation. So it's about the tax function and group finance working together to actually make sure we've got access to the right information, that where we're relying on accounting standards to help interpret it, that we've got that input, and that finally we end up with then the correct figures for the organisation coming through. So they're probably the two key points I'd add.
Yep. Very good, John. Really good. I just would point out that when you use a bottom-up approach, you're going to have these same sorts of issues and maybe a couple of other ones, including how do you keep consistent interpretation among the financial controllers around the globe? And quite frankly, how do you get them to respond timely to your request for this data, particularly in the dry runs? Now, we've taken our experience in dealing with clients on this data gathering and analysis and used them to put together RE&Y data collection and compliance tool for country-by-country reporting. We call it CBCR Web. And a couple of things that we thought were important is it was to make it so that it's agnostic with regard to data sources, so that it can either accommodate an upload of information out of a consolidation system or direct input by local units, or even a combination of the two. And we know that being able to limit the visibility of certain parties to the overall data set is important as well. So the ability to have access rights is built into our tool. So just a couple of features here that that we've learned from our work with clients in how we put together our compliance tools. And we also have talked to a lot of clients about integrating the process of country-by-country reporting and the master and local file in a unified process, which has a goal of really accomplishing two things: consistency among those three sets, and also adding efficiencies by addressing them as one piece of work rather than independent pieces of work. And with this, we put together a country-by-country web and a additional piece of software that we call TP Web, and it really helps these processes come together. And then, as you saw earlier, John was showing you some of our analytical tools, and those are built into these tools as well.
Okay, thank you, Pat. So in fact, we have attached more information on this CBC web at the end of the presentation for those of you who want to learn a little bit more about this. So from what we're hearing now, so there's a whole lot of possibilities here. We can have an Excel spreadsheet that is unlikely to be used really as a solution, I think, for most of the group, unless they're very straightforward groups. Then we have some shelf packages available for country-by-country reporting. Then we have also seen that some groups are building their own solutions to integrate this country-by-country reporting with their consolidation systems. So maybe can you just reiterate what do you think the key requirements that people should look for in these reporting packages?
Well, look, I think that the key requirements really are that the reporting package has to accommodate your data setup. And so this really speaks to the dry run to figure out whether the package that you intend to use is really fit for purpose. But I would like to just share with you some of the things that our clients are thinking about. One, of course, get the CBC reports right. How do we have a process that is effective and controlled? I already mentioned that they're thinking about how to put all of the elements of country-by-country reporting together in more of a singular process. But we're also seeing some clients think about how do we better manage margins throughout the course of the year, and what tools are available to us to allow us to see year-to-date margins, so we know that our year-end snapshot is going to come in into the range that our transfer pricing policy reflects. So those really are the approaches that I would say are most important to your selection of tools and technology. Now, I also think that there are a lot of clients who come to E&Y and other service providers and say, will you do this for us? So, John, you have some points, I think, about managed services.
Yeah, absolutely. And I think that what we're seeing there is that, as you said before, while a lot of organizations are looking at that top-down approach, I guess what we're seeing is more people moving to a bottom-up approach despite the challenges around data gathering. And that's coming around for a couple of reasons. First, the OECD and the various tax authorities have made it clear they want to get aggregated, not consolidated data. And sometimes that's very difficult to get from the consolidation systems that are in play today. Secondly, you've already got the local tax return, of course, being based on local GAAP numbers. And so despite Action Item 13 guidance saying that, reconciliations, are not going to be required, a number of groups are wanting to head off any potential questions about, reconciliation in the numbers. I think the third reason is that the group gap numbers often do generate some anomalies. They may not match the narrative at a local level, and so they might therefore raise the potential for questioning around that. We talked about this example before, where many groups don't get their transfer pricing positions closed out in sufficient time for the group numbers, and so the ultimate local gap numbers is what's going to be the sort of the touchstone for those elements. So using bottom-up numbers gives a chance of a smaller discrepancy there, and so I think we're seeing organisations ask themselves questions around that and say, should we be really going down to the local gap or local numbers so that the numbers that are presented match the narrative around things like the tax returns and the statutory financial statements? So I think it is a question that organisations are asking themselves now as they go through these dry runs and think about this.
Okay, well, and I would like to know Pat's comments on this here as well, but maybe before we move to Pat here, let us find out what our audience are doing with another polling question here. You'll see that in the screen on what gap are you planning to report under. So maybe or maybe John, can you please continue?
Sure, Hanno. I think what we're seeing organisations do here is really start with a process of saying who in the organisation is accountable for the report. Is it tax or finance? And we've seen examples of both. And I think to some extent it doesn't matter as long as there's clarity around how it works. But I would anticipate that if and when any questions come up, it's going to be on the agenda of tax to work it out. So once you get some clarity around that, the process of the reporting really needs to be broken down into its component parts around the gathering of financial data, the analysis, the explanation of anomalies, and if there's any remediation required, that as well. And so the foundation to that process is, really working out who's responsible and driving that forward. So I think we recommend that you would use your 2015 year-end data to help, improve the knowledge and access to that information. We've also had a number of clients who've asked them to help them go through that process, given the data we have access to, and they've been a bit surprised at some of the results. So, Pat and I have talked about this in the past. However you go about it, getting a dry run in place is going to be a very important process to go through. And certainly if you're using organisations like us to help with your compliance information, then it's probably something you can get up and done pretty quickly where that information is being managed globally. Pat, have you got some more to add in there?
Well, I could go into a lot of detail about some of the things that we've experienced. I guess I would just like to mention one thing and then maybe get Arlene's thinking about how what we put in these country-by-country reports matches with what information might be out there in the public. The one thing that I would say has been a surprise for many companies is the discrepancy that they have relative to entities. I mentioned this before. Let's call it corporate secretarial. We've had situations where the legal department, the controller, and the tax department each have a different set of company hierarchies, and they don't match. We found situations that they are substantially off, and so I would just ask people to use this as a situation to do a health check around corporate secretarial. And then I think there should be some thought given to how the information that we have in the country-by-country report matches up with with what the public audience knows about us, and maybe we can skip ahead to that topic to make sure that we get it in on this webcast.
Well, I know there was some discussion over the summer about calls for public disclosure, and also we saw earlier in the year the European Commission did publish a draft directive that would have, if adopted, have called for a version of public country-by-country reporting. But I think at this stage it's very, very unclear about how much traction that public reporting proposal will get in the EU, because our understanding is that not all of the EU members are in favour of that. So I think that's still an ongoing question to be determined.
Okay, so thank you, Arlene, for this. So I think that brings us almost to the end of our time here. So, but before we go, you'll see that in the screen a recap slide on the timeline of what organizations should be doing over the next 15 months. And as we have been discussing, first thing they should do is to identify the constituent entities. Then we'll probably need to notify the pertinent tax authorities where the reporting constituent entities are. Then they should, of course, be prepared for country-by-country reporting, and probably a good practice would be to undertake some dry runs to confirm the data sources and the responsibilities within the group. Then, and maybe also check for consistency with other transfer pricing documentation, as we mentioned, with the new master file and local file documentation reports that countries will implement. And sometimes it's also advisable that this template should be discussed as well with the boards and corporate bodies of the group, because at the end of the day, these reports will be exchanged between tax authorities through the exchange of information mechanisms, and that will happen within the 18 months after the reporting year end. And then once the tax authorities receive this country-by-country report, then this report will be used for performing, as we said, high-level risk assessment. But depending on the outcome of this assessment, these tax authorities may follow up with questions on the template, or they could even start a tax audit, in fact. So with that, I think that we are already out of time for today. So I just really want to thank you, all of the panelists, for being here today with all those tremendous insights on this topic. And of course, I want to thank you for your participation today on the webcast. If you feel like you want to keep discussing with us these issues on country-by-country reporting, please feel free to contact us. You will find our contacts in the presentation. And lastly, if you have been with us for the full 90 minutes, responded to the polling questions and completed the feedback, you can now download your education certificate by clicking on the purple CPE icon at the bottom of this interface. And maybe now, before you sign off, please just take a moment to open the red feedback icon and let us know what you thought of today's program. And as always, we hope that you'll join us, of course, for future webcasts. From the Thought Center, I'm Hanno Bustos, and we've been bringing you insights on country-by-country reporting. Thank you, and goodbye.
Thank you for joining today's conference call. You may now disconnect.